If you've got money sitting in a savings account right now, here's something you need to know. Two people can put away the exact same £10,000, but after 10 years, one of them ends up with thousands more, simply because of how their account is taxed. In this video, I'm going to break down how interest actually works, why tax can eat away at your returns, and how using an ISA, one of the simplest tools available in the UK, can make your money work a lot harder for you. And don't worry, we'll keep it clear, simple, and practical so you can apply it straight away. So let's start with something really simple. Interest. When you put money in a savings account, the bank pays you interest. Think of it as a reward for letting them use your money. If you save £10,000 and the bank pays 4% interest, at the end of the year, you'd earn £400. That's simple interest. Your original £10,000 earns the same £400 every year. But in reality, the most powerful concept is compound interest. With compound interest, you don't just earn money on your initial £10,000, you also earn money on the £400 interest that was paid in the first year. So in the second year, you're earning interest on £10,400, not just the £10,000. Now it might sound small, but over time, the difference is huge. If you leave £10,000 in an account at 4% for 10 years with no withdrawals, you'd end up with exactly £14,802 thanks to compounding. Without compounding, if you just earned simple interest, you'd only have £14,000. That's an extra £802 just for leaving the money alone. Now here's where things get interesting and slightly less fun. In the UK, most forms of savings interest are taxable. If you're a basic rate taxpayer, you get a personal savings allowance of £1,000. That means the first £1,000 of interest you earn each year is tax-free. For higher rate taxpayers, that allowance drops to £500. And if you're an additional rate taxpayer earning over £125,000, you don't get an allowance at all. Every pound of interest is taxable. So let's take an example. Suppose you've saved £50,000 in a bank account paying 4% interest. That's exactly £2,000 of interest in a year. If you're a basic rate taxpayer, the first £1,000 is tax-free, but the second £1,000 will be taxed at 20%, which means £200 gone, leaving you with £1,800 net interest. If you're a higher rate taxpayer, only £500 is tax-free, and the remaining £1,500 is taxed at 40%, which means £600 gone, leaving you with £1,400 net interest. And if you're an additional rate taxpayer, the whole £2,000 is taxed at 45%, so you lose £900, leaving you with just £1,100. So even though the bank pays you the same interest, your net return can look very different depending on your tax bracket. This is exactly why ISAs, individual savings accounts, are so powerful. An ISA is basically a tax wrapper. Imagine it like a protective bubble you put around your money. Now once your savings are inside, all of the interest, dividends, or capital gains you make are completely tax-free. Right now, you can put up to £20,000 a year into ISAs, and there are different types. A cash ISA works like a normal savings account, but the interest is tax-free. A stocks and shares ISA lets you invest in funds, shares, or bonds with all returns tax-free. An innovative finance ISA is for peer-to-peer lending, which is a bit more niche. And a lifetime ISA is designed for first-time house buyers or retirement, and even comes with a government bonus. But here's the point. Even if you're just using a cash ISA, you're making sure that interest you earn isn't taxed. So let's go back to our earlier example. £50,000 saved at 4% interest earns £2,000 per year. In a normal account, a higher rate taxpayer could lose £600 to tax, taking their interest down to £1,400. In an ISA, they keep the full £2,000. Now let's put it together. Imagine two friends, Sarah and James. Both saved £10,000 at 4% interest for 10 years. Sarah puts her money in a normal savings account. She's a higher rate taxpayer, so 40% of her interest gets taken by HMRC each year. After 10 years, she has £12,676. James puts his £10,000 into a cash ISA. He pays zero tax on the interest, and after 10 years, he has £14,802. Same deposit, same bank, same interest rate. But James ends up £2,126 better off. And that's just with £10,000 over 10 years. Scale that up to £100,000 over 20 or 30 years, and the difference is tens of thousands of pounds. Now, a lot of people ask, so what's the catch? Well, there isn't really a catch. The main limit is the £20,000 annual allowance. If you're lucky enough to be saving more than that, you'll need to look at other wrappers like pensions or even international investment bonds. Another misconception is that you have to choose one type of ISA. That's not true. You can mix and match. For example, you could put £10,000 in a stocks and shares ISA and £10,000 in a cash ISA in the same tax year. The only rule is that you can't exceed £20,000 in total. And finally, a lot of people think ISAs are just for the wealthy. They're not. Even putting away a small amount each month can make a huge difference when it compounds over time. So if you want to make sure your money works harder, there are a few practical steps. First, check where your savings are sitting. If you've got a large balance in a normal savings account, you might be paying unnecessary tax. Second, try to maximize your ISA allowance each year. Even if you can't hit £20,000, use what you can, because unused allowances don't roll over. Third, think beyond cash. If you're saving for the long term, a stocks and shares ISA may offer better growth potential than a cash ISA. And fourth, review your tax bracket. Higher rate taxpayers have more to gain from ISAs since their interest is taxed more heavily outside of them. So think of ISAs as a foundation. Before you move on to more complex products like pensions, VCTs, or EIS, make sure you've nailed this simple, tax-efficient option. So let's wrap this up. The interest rate your bank offers is important, but what really matters is how much of that interest you actually get to keep after tax. And ISAs are one of the simplest, most effective ways to protect your returns. The lesson is simple. Don't just focus on how much you save, focus on where you save it. Because over the years, that choice can add up to thousands of pounds. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about personal finance, be sure to check out theindustryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.